If you want to make it logical and objective discussion, crime rates are high. But if the crime rates are high, what does that mean in terms of property? That means people don't want to live there, right? But if people don't want to live there, why is the demand for this particular suburb still going up?
The types of property that people shy away from or get told not to buy or get sold after playing brand new attracts a better quality tenant. Like they get sold the wrong thing and they don't realize it. Welcome to Property Banter by Pinnacle Buyers Agents. This is the top 5 properties under 600,000 in Queensland. With an unexpected twist, one of them is not in Queensland. Thank you so much for joining us. I'm joined by Mr. Adi from Alea Property. Please share, like it, subscribe it, and enjoy.
So, Michael, we spoke about the top 5 suburbs in Victoria, right? Yeah. I'm seeing some great data sets in Victoria. I wanted to learn from you about the top 5 in Queensland that you're seeing that are under 600, which is hard to believe, but...
Hard to believe because it's hard to find under 600K. It's Queensland hasn't it been, and it's funny because when I got here it was not the darling of the Australian property market, but it has become such a powerhouse in Australia, hasn't it? Outside of Sydney. Sydney's on its own. It's a whole other category. But Brisbane has become, it's just performed so solidly. We're seeing, in the last 6 years, and we touched on it in the last podcast, where, we're buying properties for $250,000 5-6 years ago, right? On an
absolutely bizarre to think that's a thing.
You
right?
can't believe
$250,000.
Yeah. But you know what? We're talking highest percentage of renters in an area, high crime rates, all of those stats that people look at that I don't value, right? Because there's a whole bunch of metrics that I would look at, and there's a bunch of them that I don't even pay attention to. That's probably for another time.
But you know what's interesting though? Can I just touch on that? Because this point comes up for me a lot, right? I actually spoke to a client 3 days ago, and she was talking about a Melbourne suburb, and she said, though, crime rates are really high. Cool. Okay, crime rates are really high. But I think if you want to make it logical, if you want to make it an objective discussion, cool, crime rates are high. But if the crime rates are really high, what does that really mean in terms of property? That means people don't want to live there, right? But if people don't want to live there, why is the demand for this particular suburb still going up?
Supply demand has nothing to do.
Exactly. It doesn't care about your feelings, and it doesn't care about, crime rates, right? If crime rates are really high, what you're basically saying is my property is not going to grow in value because no one wants to live here. But that's not what the data is saying. The days on market are dropping every single month. So what does crime rates really have to do with capital growth, right? That's the question you got to ask yourself.
And ask yourself, how can we even have a crime rate statistic if no one's living there?
Correct.
So that means there's a demand.
Exactly.
People live there.
Exactly.
And crimes are being committed against them.
Correct.
Because they are there. They're living there.
That's right.
So it's showing there is a demand. And,
that's right.
And you know what? The best way I explain this is like, you got properties in Dubbo or Broken Hill or Alice Springs or wherever they are, right? Just because you wouldn't live there doesn't mean someone didn't grow up there, they don't have family there.
Bingo.
Right? So they're from there.
Exactly.
Right? I'm not from Truganina.
Yeah.
Is that correct?
That's right.
Okay. But that doesn't mean someone's not.
I'm not sure why you looked at me like that.
Sorry. But that doesn't mean that someone's not living there currently, that their work isn't there, that their family isn't there. So that's where they are because that's where they're at this stage. You've seen those people in Alaska living, it's absolutely freezing. Stuff that. Oh, well, you wouldn't catch me doing that. I even think it's cold up here sometimes for 2 months of the year.
But if the data told me, I would invest in an igloo. You know what I mean? I would. If the data told me that,
I would. The data. You love the data.
So crime rates, man, it's a very topical thing amongst investors and sort of new investors.
Yeah.
But really the question you're saying, or the question you're asking is that the crime rates are they going to impact my property prices? Yeah. If that was the case, then why is days on market in certain areas still dropping? Let's talk about Townsville for a second, right? Townsville 3 years ago, probably still is, pretty high crime rate, right? Not great. It's not great over there. What's happened to the property prices over there?
But let's touch on how it actually works. The crime doesn't happen everywhere in Townsville.
That's right.
Not every house has robbed. A crime committed on it in every street, everywhere, all the time. It's like saying the Australian property market has grown this much, or it's gone down this much by 2% in the last whatever. The Australian property market does not exist. Okay, there's markets within the state, and then within that suburb, there's a good section, a bad section, and it's got nothing to do with it. So whatever's happening in Townsville with cars being stolen and things being done, mate, that was standard shit back in the 90s. That's everywhere cars were being stolen, but it doesn't impact property, because if it did, look, every investor that's probably listening to us right now has owned or owns in Logan.
Yeah, exactly. That's right. What's happened in Logan?
Crime rates, it's gone from 200, 250 to 750 now. Mount Druitt. Oh, I wish my strategy solely consisted of Mount Druitt back in the day. Solely just Mount Druitt.
Isn't that how big Nathan Birch started his portfolio?
Yeah. There you go. So there, it's all just lower socioeconomic areas, like, because I'm from Campbelltown, Seatown, and lot of crime. I was, in between Minto and Macquarie Fields. Mac Fields is like.
You tried to rob me before this podcast started. You tried to rob me.
Where's your wallet? Give me all your money. But yeah, so look, it's one of those things where, property there was, okay, there's high crime, there's a certain demographic, but I bought a $190,000 house that rented for $320 a week on a 650 square meter block. And my tenants never gave me a problem. They were amazing, right? No drama. All right. And I had a property in Bondi, had nothing but drama. Property got trashed. A bad property manager. By the way, there's also a lot of crime and drugs in Bondi, regardless of what people think. Both properties went up the same amount in terms of capital growth. So in actual fact, the Bondi property was one that was costing money to hold and was more of a status type of property to say that you have blue chip for the sake of saying you have blue chip. When in actual fact, it's absolute rubbish as an investment, because blue chip's a scam. But, the Mount Druitt property, great tenants, looked after it, positive cash flow. 80% LVR, I bought it. I put down 20% deposit on 19K or 38 grand, right? So that was just providing amazing cash flow. And if you had that, that's now 850 grand, are they? 800, I think. So when you look at that positive cash flow asset from day one, just sitting on it, rent's going up, that's amazing. So the types of property that people shy away from or get told not to buy or get sold, after playing brand new, attracts a better quality tenant. Like, they get sold the wrong thing and they don't realize it. And it's all got to do with mitigating risk in managing your portfolio, and that is having a good property manager, making sure they vet your tenants, making sure that you have landlord insurance. This is not financial advice. Making sure you have, I always separate my landlord insurance from my building insurance, and I get a specialist landlord insurer prior to the tenants moving in, because you can't get it and for it to be valid after they stop paying rent, right? So you mitigate risk as much as possible, and you ensure that you do things the right way, and I think we've had tremendous success, and I think over time you really realize that a lot of people aren't selling you the right thing. Correct. A lot of experts are not experts. But
then this sort of I think goes back to the whole crime rates thing. Crime rates is fine. Crime can happen. Like you said, it doesn't happen on every house. Happens everywhere, right? Even in Vaucluse, there's probably crime happening, right? But the key thing to ask yourself is crime rates. What you're really asking is, crime rates mean people don't want to live there. People don't want to live there means my property is going to go backwards. My property is going to go backwards means I'm going to lose money, right? That's really the linkage you want to be making, right? Because you're not living in that property, so why do you care? But now that we are in 2025, we have things like H-tag available to us. Literally, I can switch on, my computer. Within 3 minutes, I will know what's happening in a suburb like that. Yeah. That didn't exist 5 years ago, right? So you have access to data, and that data, if the crime rates were terrible, right, enough that no one wanted to live there, the data would be reflecting it. The days on market would be trending up. The stock on market percentages would be going up, right? And the hold periods, the amount of time someone holds that property, would be going down, right? So why is it some of the suburbs that I've been told about are high crime rates? Why is the opposite happening, right? So again, if you're an objective investor and something's been playing on your mind about crime rates in certain areas, you have to ask yourself objective questions. If you're an emotional investor, 2025 is going to be a rough year for you, because it's again sitting on the sidelines. It's again sort of seeing the market move by, and 2026 will roll around. And what you're going to be saying is, property prices are unaffordable. I wish I bought 12 months ago. So So
But that's victim mentality.
it is.
Like property wasn't affordable when I started.
That's right. 30 years ago, it
It wasn't affordable. It's never property is never affordable
all
to
relative,
anyone
man.
who has no money.
Correct.
Everything's unaffordable. Oh, I'd like to buy a mega yacht. Kind of unaffordable for me. Right? But that's just how it is. It's quite interesting. Going back to metrics also, understanding data is about knowing how much you should look at a particular metric and allocate importance to that metric.
Nice. Now we're talking about weighting. Oh, so Matt from H-Tag, he's sitting there.
Let's get into it. Like ERSAT score in lower socioeconomic areas. So if Mount Druitt doesn't have a great ERSAT score, that doesn't faze me. I'm expecting that. But that's not always going to be a way. That's not always going to be a negative. So you need to know which metrics to really focus on. So like ERSAD.
IRSAD, just for context, I guess, it's what the ABS gives. It's a score out of 1 to 10, right? It's what the ABS tells us at a broad level. What is the socioeconomics of that area? 1 being the worst relatively, 10 being, think about your Vaucluses of, Rose Bay in Sydney. That's your 10 high, very high income, very expensive property, and then the ones are, like the Mount Druitts and.
So it gives you it gives you an idea on how much money the people have in the area, so you know whether they can afford it or not. And usually we see some great ERSAT scores in areas where it's 8, 9, 1.1.
That's a great sign.
It's a really good spot. But not everyone has that money, right?
No, exactly. And I think what I will a bit of context to that, ERSAT score can be low. If your purchase price is sort of 500, 550, 600K, I'm okay with a low.
Yes.
Because remember, for me, like ERSAT score is a reflection of, how much the earning potential is, of the demographic in that area, right? If a ERSAT score, and to be honest, this is almost impossible to achieve anyway, but if the ERSAT score is 2 or 3 and the average price of the property there is 2 million, I'll be a little reticent to invest there because I'll be like, oh, what's actually going on here? It seems like a bit of a shaky thing because it's going against all norms, right? But if the ERSAT score is 1 or 2 and I'm able to pick up a property for 480, 490, that property can still go to 800, 900 one day, right? Yes, sure, it might hit a bit of a ceiling at some point because it comes back to the fundamentals, right? How do property prices increase? Owner-occupiers who earn a little bit more can put a little bit more towards the property, and that's what sort of raises the property prices over time, right? There's, of course, a lot of other interplaying things at play as well. But ERSAT score, going back to that, socioeconomics, crime rates, all of that good stuff. If you're buying in a cheaper market, right? If your budget is 500, 550 and you still want an ERSAT score of 10 where there's no crime and everything's rosy and there's a rainbow every day, then you probably don't know what you're doing to be sort of, to be
And you know
direct.
what? ERSAT score, when you look at ERSAT score in areas that are slightly changing, like your Miller or your Heckenberg in Sydney, you know what? I still, and I'm obviously from Queensland now, I got out, but
I can tell.
Yeah, I'm a Queenslander, but I don't go fishing. I have a boat anyway, so I'm not, or a jet ski. Oh, a jet ski is a Sydney thing. But look, I don't like when you look at the ERSAT scores in some of these areas, they might be considered like very low. Like Broadmeadows has a low ERSAT score. Let's talk about Broadmeadows, and I was going to use the Sydney example because I'm from Sydney, but let's go to Broadmeadows. And Broadmeadows reminds me very much of Miller and Heckenberg and those Liverpool suburbs. Those sort of housing commission gentrifying areas that all now have, every Habib in the area and so on. They all have, Lexus and AMGs and all that sort of stuff, right? Broadmeadows, in a street that we bought recently, that had non-stop developments throughout the whole street. From the townhouse developments to people just knocking their house down and building themselves a brand new home. So whilst it's the lowest, probably, is it the lowest in Melbourne? ERSAT score?
Probably one of them. Yeah.
Not far off, right? Yep. It's going to be in the bottom 5. But there's money there. Regardless of if the locals aren't submitting their 100% of their income tax returns, okay? You rest assured there's money there. Don't let that fool you, because the ERSAT score is great as just another metric that we lay up on a heap of other metrics, right? To form the narrative for us to understand how an area sits, how healthy it is, and what direction it's heading in. But, it's one of those things where I know that there's money there. You drive through, you see it. It's happening in the developments. It's in the cars they drive. It's in the fact that families there, they're the family homes where the migrant families would have come once upon a time. Now they've got, a couple of the sons working, whatever, they're earning money. Like, the families have money. Don't think just because the URSAD score is a 2, that those households have no money. Those households have money, and that $550,000 house in Meadow Heights or Broadmeadows has so much potential to grow.
And that's the main thing, right? I mean, when I sort of look at the data and I look at a low URSAT score, 2, 3, 1, I've bought in 1 before as well. Again, it's all relative, right? It's all about what does the price point of that suburb tell me, right? If I'm buying a 1 and I'm buying a 950K property, I'll be a little bit like, surely, there are 15,000 suburbs.
You'd have to look into it.
Yeah, you have to look into it.
If that was
you dig into it, right? Like, and it's all very contextual. You cannot make a decision on a suburb. You can't blanketly say this suburb is bad or good. It is all relative. It is, do I have a better option, right? Okay, let's make this very simple. If I had 2 suburbs side by side, one had a URSAT score of 5, one had of 1, but I could buy property, everything else, let's say, was equal, but I could buy a property at 550 and 550. I would obviously go for the 5, right? Because to me, I'm like, yeah, that kind of makes sense because the data tells me that the socio-economics of this area is better. So it's always relative. It's not that one is worse than the other. It's sort of how does it all map out? And then it always goes back to your risk appetite and what are you trying to achieve in the long term, right? That's what it goes back to. And then you layer it with 11 years of experience of like a gut feel. This is great potential. 550K, 700 square meter block, 30, 40 kilometers out from the CBD. You're probably going to see a pretty decent rise in the next 10, 15 years, right? So we haven't even gotten into the top 5 suburbs in Queensland. So should we get into it?
We haven't. Let's
audience
get into
has,
it. I had more to talk about that.
I know. Audience is livid.
We had so much to go on. But
What's
so let's
1?
get into it. Let's get into Gordonvale.
Oi.
So Gordonvale, Queensland, 4865. So is a suburb of Cairns. Are you familiar with Gordonvale? So Gordonvale, we've been buying there. That's one of the suburbs we've been buying in. There's quite a few suburbs we've been buying in Cairns. Absolute powerhouse Cairns has become. Once upon a time, it was not. But like everything, that we've been talking about, everything comes around and has its day. What I'm noticing on the ground is, before we get into the data, is a lot of people constantly migrating north. And this is what I'm seeing here locally as well. So whilst we do have a lot of Mexicans, we do have a lot of people from the southern states, and I'm one of them, let's face it. But, they might come up and they might go to the Gold Coast or Brisbane or, Melburnians really love the sunny coast. But the people that sell up from Brisbane, I've noticed, some of them do trickle over to the sunny coast. They cash out and then they look for something, whether it's hinterland or it's near the water. And then people on the sunny coast cash in and they've already got a family member that's already moved north from a previous time. And this constant trickle effect upwards to a warmer climate and affordable properties, I'm seeing constantly happening. Kind of like when all globally, a lot of the major capital cities cycle and New York goes up a great deal. Shortly thereafter, a lot of people start buying houses in Florida. And it's the exact same thing that we notice. The human patterns are the same. So whilst you can look at, data, but it's good to sort of, hear it from the agents and see it on the ground. Why is this guy selling? Where are they going? What's their reason? And it's affordability and then moving closer to family, moving to a warmer climate. So Cairns.
But can I just say though, your point there, right? I'll go back to the data because I'm the data guy, right? I don't have 11 years of experience. So for me, I've got 10 years of experience investing, right? I've been an investor for 11 years now, buyer's agent for about 1, right? Yeah. What I have seen play out, what you just said, you were talking about on the ground understanding of how markets are shifting, right? Yeah. I'm the data guy. If I translate what you just said, that people are moving north, warmer climates, closer to family, population's increasing, what does that translate to? That means there's more demand for the few properties that are there. And that's why Cairns, Gordonvale, I can almost see the graph in my brain. The days on market has been plummeting there. The stock on market has been plummeting there, right? So what you just said translates to data, right? It's not just a gut feel like I can see people moving. It's not like my neighbor moved to Cairns and that's why Cairns is going to go up. It's like, no. People are moving there. The population's growing up. There's money being poured, millions of dollars being poured into Cairns. all of this, you peel it all back, you look at your days on market, you look at your stock on market percentage, your inventory levels, your discounting. There's no discounting in cans. You can't discounting, but 5 years ago, you got a pretty healthy discount in cans, right? So you can see all of this. And this is what I love about, things like H-tag and stuff. You can see all of these things that we are talking about. You can translate that to data. That's why the guys from H-tag were talking about, sort of cans 6 months ago. I put someone in cans in, I think, June, right? And it was a banger, right? They got an amazing deal. 700 square meter block. I think it was like a 550 or something that they bought it for. It's unbelievable, right? That property itself would be probably 700.
322, 422?
422. That was a good one. Yeah,
we're getting threes now.
That's right.
At that price point.
That's right.
Yeah.
Right? So you sort of think about it. All of this can be seen in the data, and you just got to learn to read it. That's what you and I have gotten good at. We can see the on-the-ground stuff because we talk to agents. That's 90% of our job, right? Learning what's happening on the ground. And then we jump onto, a subscription tool like H-tag and be like, oh shit, we can actually see this now. So,
and that's what we had to learn back before we had all the data we have today. Learning on the ground, like I was talking to Matt the other day on a live about how I talk to the agents and I ask back in the day their inquiry rate. So how many phone calls do they have? Because they call, a lot of people call the office. So how many inquiries in the office, how many emails did you get? Oh, it's up on last month. I'd do things like that. Yeah. Or, if you're renovating to what? What spec? Like, what is the most in-demand rental property here? You need to cater for that market. Now, what I want to give away is a bit of a secret on how this works. And that is on the ground information that I'm giving out about Cairns is not just about Cairns, but it's about Queensland in general. So when you're investing in Queensland, look for owner-occupier appeal properties that are in the north, because Brisbane has gone up heaps. And what was Brisbane the other day? 1,083,000 median price. Now, a lot of people are selling up and they can run to Cairns. And if you're in Cairns, make no mistake about it, you need a pool. Okay? You need a pool because that pool is usable 12 months of the year. Not so much Truganina, right? So you want to be buying a house that is going to appeal to that owner occupier in future. So buying the 422 with that nice pool in a barbecue area, and right now they're starting to really move up. Right, you picking that up, June was a cracker. So it looks like you kind of know what you're doing. But that's owner occupier appeal 422. You want to be buying, and we've probably got to do an episode on investor stock versus owner occupier stock so people could really know the difference. But buying owner occupier stock that an owner occupier is going to turn around. They could be a first home buyer owner occupier. They could be someone moving from Brisbane. They might want the house that's roomy and it's at 422 and it's clean, nice, neat. Maybe 500 square meter block. You don't want too small. So 500, 450, 500, 600. Anything big is great. And having that pool and that family area, because that pool up there that's usable 12 months of the year is amazing for family. Right? So what you're seeing is people not being able to buy that 1.1 or $950,000 house in Brisbane, but they go, you know what, 650 buys us something in Cairns. I can now move my family there. I'll work from online or whatever. My wife can, get a job, whatever, or, vice versa. And they're all of a sudden buying value. And it always comes back to affordability. Property prices can't go up unless they're affordable and buying that value. So in Queensland, we're seeing that trickle north because Brisbane's become so expensive and people naturally just start moving north. Because I tell you something, what I've noticed being in Queensland since 2016, no one moves south. Okay.
Hurtful.
I'm going to hurt a lot of people. I even hate going back south. Like I dislike it. I don't want to fly down. Even if I've got to be there for 2 days, it's painful. I don't want to go back. I don't like it. It's just a different vibe. Once you come up here and it's a little bit more relaxed, and because I'm fast paced as it is, right? So, we like it up here, and a lot of people, what they do, they choose to just move north as opposed to south. So based on that, if you keep buying the value and you keep buying properties that owner occupiers will like to move into with a good data set, backed by a good data set, you're going to do well.
You're going to do well.
100%. Yeah. So, no, 100%. But look,
nothing to add. That was good.
Thank you, sir.
What's number two?
Let's get number two. You might know this one. Mount Sheridan.
Hey. Who doesn't know Mountie?
We have quite a few deals done in Mount Sheridan, and I think we've got about 3 currently over the last 2 weeks under contract. Mount Sheridan is another spot you are going to struggle to get the quintessential, an occupier 422 there. But if you try and squeeze in a 3-bedder, you could get one in the high 500s. You're going to need some contacts, and you're going to need to be super sharp with and very proactive in your search.
Or you can just call Michael.
Or you can just call me. Shameless plug. Just call me and I'll sort it all out for you. So typical price, $614K. Rents are very strong up there.
Wait, the typical price of Mount Sheridan now is 614?
614. But you don't buy 614. See, when I look at a lot of prices, like we were talking about Werribee, I think, and what were we talking about?
Meadow Heights.
You can buy in the 5s.
Yep.
In Werribee, they're there in the 5s, but we're buying in the 4s. So when something is, X amount, you better believe it. We're buying it for less. So it's hard to buy at a discount in Mount Sheridan. It's easy to buy at a discount in Werribee, but that's only for now. So yeah, we're looking at medium rents, 567. Yeah, 3-bedroom, 540, 4-bedroom, just under 600 a week. We are seeing renters to owners, 26%. Very, very healthy.
Very healthy.
Very healthy. Stock on market, 0.28.
There's 2 houses left. Michael's buying them.
0.28. So there's 10 unsold listings, it says there. Now, 10 unsold listings are probably just a couple of people who are just looking for a stupid amount. They're probably listed their $600,000 house for like 720. Like I've heard of, there's a couple of those and we just instantly dismiss them when they pop up. But you know what? Everyone's having a crack, right? We're all capitalists here.
That's right.
Inventory levels at 0.97. So 1 month.
Less than a month to sell everything that's available.
Under a month. That is so low.
That's insane.
Building approvals at 7.
Like
7.
7% or
like
7?
7.
The number 7?
The number 7.
In all
After 6, but
in all of Mount Sheridan.
9, number 7. Lucky number 7.
Oh
so look,
but
amazing.
not 8 though, right? Not 8.
Not 8. No.
Not 8.
Let's confirm.
7. Okay.
Hold period, 9 years trending upwards.
Ooh, 9 is good, man.
It's solid, but it's trending upwards. That's the main thing. We know the direction it's heading in. And I'll tell you what, it's going to continue that way. The way in which people are looking at that area as post-COVID, people love lifestyle. We're not all going into the office as much, and things have changed. And I love Cairns being gateway to the Whitsundays. Like it's an amazing playground, and to buy property with a 5 or 6 in front of it. Your clients are going
to be very happy.
I know. I was thinking we need to start taking a percentage of equity gains.
Of the capital gains.
As opposed to a buyer's agent fee.
Right.
There's a topic for another time. Days on market, 39 days, healthy. Vacancy rate, 1.34. It's trended up a touch lately.
A lot of investor activity. That's right. Yeah.
So always tends to happen. I think, what do we got? I don't have the data in front of me, but I think there's a couple suburbs in Townsville.
That's trended
upwards on that because of the heavy investor activity.
That's right. Yeah, absolutely.
In those areas.
And you got to be, and this is probably a good time to mention. This is another thing you got to look out for. Everyone loves Perth, right? Going back to the whole Perth bandwagon. Everyone loves Perth but there are a lot of suburbs that have done very well where the vacancy rates are sharply increasing. That is a great reflection that there's a lot of investor activity. And if you think about that whole threshold we talked about, like 30% owner-occupier ratio to, whatever renter, that's when you start because that comes out from the census, right? That only gets updated every 5 years. There's not a lot you can do dynamically, but what you can check is the vacancy rates, because that's something you can track on a month-to-month basis. When you start seeing that trend up, I will just consider everything. Hold your horses, see how it plays out. It's not always a bad thing. Some suburbs do trend up for a short period of time, but then things start to sort of peter out as well, balance out as well. But if you're seeing a very sharp increase for the last 6-9 months, that's when you start to question whether it's time to move on from that.
And when we're talking about metrics that are very important and you assign a lot of weight to, vacancy rate is one of those ones that are super important. And early in my career, that played a huge part.
Correct. Because you've seen some places with 6, 7, 8% vacancy rates.
Yeah, but vacancy rates have also changed. Back in the day, 2% vacancy rate was just, that's good. It's healthy. Really nothing over 3%. Now we're seeing these 0.67 vacancy rates, 1% below. It was never like this.
Yeah. But if you think about it, right, like what does all that mean, right? We've had an influx of population, right, into Australia. If you sort of take a real macro, influx of population, we literally just cannot keep up with building where are people going to stay, Michael, right? Someone has to stay somewhere, right? So that's why the rental pressures are going up. There's a massive influx of people coming into the country. They need to rent somewhere, right? There is, of course, going to be rental pressure. It's not quite the same as 10 years ago, but like in the last, a year or two, there's been 500,000 people who have come into the country. Where are they living? They're not buying their houses. They're renting somewhere, right? So if you the one thing I didn't talk about the Victorian suburbs is what I love about it is the rental percentage growth on a year-to-year basis. Some of them are as high as 15%. Imagine your yield or your rent improving on an average of 15%. That's not a normal thing year on year, right? That's a lot of money that you're sort of getting as an uptick to your rent, right? So vacancy rates being that low is kind of making sense because you have a lot more people living in the country, but buildings are not being built fast enough. So you're sort of some of these pockets where people do want to live. Yeah, there's a lot of rental pressure. And what that translates to you as an investor, that's what you and I do really well, is your rent that's $550 today, it's probably going to be $600 in 12 months time, probably going to be more than $600 in 12 months time. You know, so our cash flow that you're sort of thinking about at the moment, it's just a today thing, you know, it is going to improve. So
it's today. I remember it was $300 to rent a 422 in Sydney. I remember that.
Oh, the 70s were
more.
crazy.
I was like, I remember asking, I was like, man, if I rent my house out that I bought and I buy one other property and I rent it out, I get $300 rent. If I could get it to $320, that's good. Like, I remember that. And time flies so much. You just got to buy property, hold, wait, everything works out.
What were the 70s like anyway, Michael?
70s? Mate, I had a horse and cart.
Yeah, that's right.
I used to walk to school 20 kilometers.
Up and down. Uphill and downhill.
Yeah. So where are we up to?
I think we're up to number 2. We've done Gordonvale. We've done Mount Sheridan.
We are on Edmonton.
Hey.
Edmonton. We just picked up one for a client of ours for $560,000 in Edmonton. Still very affordable, large block size. So you can come in the mid 5s, sorry, for Edmonton. You still can. It's hard though. And you got to be careful to watch out for agents that are really shopping your offer. We've noticed that. So there's quite a few that will shop your offer and you put in your offer and then they just use it against you. Then they'll come back to you and say, well, now I've got someone at 570. Do you want to get 580? And all of a sudden it's this you know,
buying
auction.
something silly and then it's emotional and
yeah. So I tend to try and stay away from that. We got our contacts that supply us with properties direct. So
beautiful.
That's another plug.
Very good.
Sneaky.
Still in Cairns. I like it.
Sneaky. Yeah.
Top 3 in Cairns. Okay.
Oh, of course.
Number 4.
Let's go. Number 4. So I've got a little bit of a spin. All right. So for a lot of people, they're after Brisbane. And I want to throw Brisbane here, but I can't find anything on the data set in Brisbane that won't be a suburb of Ipswich. And not that we're going to start the judgment on Ipswich. We buy plenty in Ipswich and have done so. And you still can go there. But I see value right now. And if you want some short-term growth, the value is in a $550,000 to $580,000 3-bedroom townhouse. Townhouses and units are performing still because they are obviously on the back end of the growth in houses, right? So houses have surged. Then what happens is, you know, people that can't afford houses are priced out. Then they start looking at a duplex, and then they start looking at a townhouse, and then they start looking at a unit. Hence why units have been performing really well lately. And at the start of a boom, for context, at the start of a boom, houses are always number one, and they move the fastest at the start, and then the less desirable properties later on. Now, the value is in those. And we just bought one, which is a 2016. It's a Philip Usher build. Philip Usher is a builder in Brisbane, and they've done plenty of complexes. Just make sure you try and buy in a smaller complex. Philip Usher 2016 build for $580,000. And we're 35 minutes to Brisbane. So the value for money, you got a bit of depreciation, you got location, you got Brisbane, which everyone wants. Yeah. And that's what you're settling for. So if you're looking for something like that, I think that, and your budget is 600, which mind you, my entire client board, I think over 50% is I've got 600K maximum to spend, and I want Queensland. So that's an option for anyone out there that has 600K but wants Brisbane and doesn't want to end up in a bad section of Ipswich with a high crime rate.
Bit of a curveball.
Yeah, 100%. And the last one, I want to throw something out that is up north. That's not Queensland.
Even further north?
Yeah, even further
north. Isn't that the ocean?
I've only been here once. And
Japan.
No, just a little bit
Antarctica.
south. A little bit south.
A little bit further.
But you know what? The flight is going to feel that way, and it is Darwin.
Darwin.
So Darwin. So
Michael's going rogue, everyone.
we're buying in Darwin for our clients, and it's one of those that we're just doing now. We've been talking about it since November internally, and like, hey, Darwin's coming up on the data set. Darwin's coming. And I'm like, yeah, we'll get to it. Not yet, because there are other places, but we've done a deep dive, had a look. I've got contacts up there as well, and we've really looked into it, and it is solid. The fundamentals are solid. Darwin,
you're gonna laugh at this, Michael.
Talk to me.
So, bit of an announcement.
You just bought there yesterday.
For myself. I'm
Yeah.
buying everything. Bit of an announcement from me.
Go.
So, Alea Property is actually changing a little bit over the next week or so.
Talk to me.
If anyone knows Reedham Saeed from Australian Property Talk, so Reedham and I are effectively going into business together. We're becoming partners for the property, for the Alea Property, the buyer's agency. We're going to do this sort of hand in hand from going forward. And it's funny, Darwin is something we've been talking about for the past month or so.
No.
As part of,
Congratulations.
thank you. I appreciate you, Michael. Yeah, it's quite an exciting sort
But
of
it's like
thing
it's like you know property or something.
Yeah, exactly. That's right. That's right. Property banter,
Unbelievable. So
Unbelievable.
no, 100%. And you know what's funny is we'll rarely disagree, because we're on the same page with with what's good and what's not. But Darwin, since we're all looking into it, you know what's going to happen now? We're going to get whoever's buying now in the next month is going to get all the best deals, and those who are going to show up in 6 months' time, it's going to be it's going to be a riot, I think. So,
But Darwin's such an interesting one, right? Because Darwin's been put it kindly, it hasn't performed very well in the last 10 years,
lagging.
right? It's very, very laggy. It's sort of like the black sheep of the Australian property market, right? But having said that, the data is showing good. But I will also layer that by saying I will only put certain types of investors in Darwin, right? This is a personal strategy for Reedham and I in Alea Property. If you have a certain level of risk appetite, right? Of course, budget has a big part to play in it, because yields are really good in Darwin, right? I love the yields over there, right? But if you have a certain risk appetite, that's when I sort of plug Darwin to you as a suburb, or as a sort of city to invest in. Because I've noticed I have brought up Darwin a few times with a few clients, which I thought...
they won't listen because they haven't heard it anywhere else. So if they haven't heard it previously to you...
And Darwin just in itself is just like, Darwin? The place with the crocodiles? What are you talking about? And that's where our job becomes even harder to sort of educate our clients, because you're sort of buying somewhere where literally no one is talking about. Yeah. Like literally no one, right? So you're a first mover, in a state that people don't actively invest in, or not historically anyway. So Darwin to me has been a challenging conversation to have, but it is something that Reedham and I have been talking about quite a bit. I think we do have people in our sort of sphere, like our client sphere, who would be the ideal people. The people with 4 or 5 properties. They've done their thing. They're happy to go into something a bit more speculative, a little bit more risky. The data is great, but there's the risk appetite as well. So I will layer that. Whereas if someone sort of tells me, hey, there's a 580k townhouse in 35 minutes from Brisbane, that's a lot easier conversation to have.
It is, because they want to hear it. This is one thing that really, it kind of bothers me with some of my clients. And it's like sometimes my clients just want me to tell them what they want to hear, so that they can go, Michael's told me what I wanted to hear, and I'm buying Brisbane, and it's Olympic Games, and I'm happy now. I can sleep well. And I feel that they want that
confirmation
from me.
bias,
And
right?
it really,
that's all it is.
It hurts me, it annoys me, and I'm not upset, I'm just disappointed, right? But it's one of those ones where I want to tell you what's right. And I want to maybe even be a little bit controversial with you here. I might even say, like, if I was starting out from scratch, I would buy Darwin over Melbourne right now.
Really?
I would buy a Darwin over Melbourne right now.
Wow. You want to take it outside?
I don't want any trouble, okay? But I would buy Darwin over Melbourne, and I would buy Darwin under market value, and I would buy it with that high rental yield, and I would extract that equity super fast, and I'd still get into Werribee.
Let me ask you something. If you went back to where you were, right? No properties, but you didn't know what you know now, would you still
I'm basing this on what I know now.
Okay, so you know what you know now.
Yes.
You've gone back 10 years, you don't have any property.
Yeah.
That makes sense.
Yeah.
Honestly, I don't blame you.
If it's based on my knowledge now, it's Darwin.
Yeah.
It's Darwin over Melbourne.
Because
for shorter term.
100%. But again, and I think that's the key point, right? You said for shorter term. So if you had come in and you were like, you know what, no, I'm buying for the next 10 years, Melbourne would again come into the picture. But if my intention was, no, I want to buy somewhere, buy real under market value because there's just no competition for me right now, then go and extract the equity in 12 months. Not maybe because the market will move because the supply and demand is telling us that. But I know in 12 months time, I want to pull out my 50, 60, 70, 80 grand. I want to go plug it in Melbourne anyway. So, you know,
I can do it.
Win-win, right?
Yep.
But it takes a certain level of what's a gumption? I don't know what the word is. Like some certain level of like experience.
It's experience.
Exactly.
That's
right?
what it is. I'm far from a genius.
And it goes,
I'm a security guard.
That's right. No, we know you're not a genius.
Yeah.
Like we've confirmed that.
Can I get that in writing? Can I get that on email?
But you can't read, so that won't help.
But we have to read. Who told us that? But it's 20 years. You know, it's 20 years since I bought my first house in 2 days' time, right? Wow. Since I slept on the floor of my first house, which was 2005, January 31st. So 20 years of real estate, 11 years as a buyer's agent, building, you know, many portfolios, you eventually get a feel and understanding. And the thing is, it's hard to just say to someone, yeah, it's Darwin. Yeah. Darwin. Why Darwin? You know, well, why Perth years ago?
That's right.
I've got successful property investors I know that I've helped with their portfolios and they're retired. I've said to them, come to Perth with me. Nah, can't do Perth. It's a mining town. Like I've said this the other day, my late grandmother, who never knew I had a property portfolio. She just seen me on Channel 9. You know how funny this is for my grandmother? Because I don't just, and I said this on another podcast actually, and she still gave me $100 when I left, like in the handshake, yeah, buy yourself something, you know. It's like grandma, like I'm rich, you know, Baba, I'm rich, okay. I've got money, you know, like I'm all right, okay. You know, because I'm rich in comparison, right? Like, man, it's all relative. They're just on pension and they've come from another country and they just live simply, and you know, I've got it all. But my grandma, she's like, I just told her I'm doing well, but how am I going to explain to grandma, hey, grandma, you know,
capital growth.
I refinanced this and I did that and then I did this and did that. Like, you can't explain that to her. She doesn't know. She's never owned a property. Anyway, and she was telling me, don't buy in Brisbane, it floods. You know, God bless her. So everyone will have that opinion and it's just a matter of time until it happens. Then they realize their mistake and then they're like, oh, geez, I should have bought that. And everyone has that story. I should have bought more real estate. I should have bought this. I should have done that. Even we have it. Sophie in the back here, she's got that story. We've all got that story.
We do, man. Seriously, I mean, in the 10 years that I've been investing, I mean, one of the worst things about having knowledge now is remembering all the things you missed out on. Like the things you could have done, right? There was like a 5-year period I didn't invest at all. I didn't think about it. I was like, oh, you know, just left it. I was just, okay, my property's growing, it's fine. Yeah. Didn't really understand refinance, didn't understand equity extraction, didn't realize it was tax-free. Like all of these things, this is going back to our earlier conversation about the system keeping you down. No one teaches you this stuff in school, right? No one's teaching you that, hey, if you take money out of your property that's gone up, you put it in the offset account, technically it doesn't cost you a lot more money, right? There's no money because it's being offset with the loan, right? So that's a learning, but you have this cash available to you to put it into the next thing that comes along, right? All of these little things that you and I have learned the hard way, right, is what we are trying to pass on to our clients now. So there's always going to be opinions. There's always going to be people who are going to tell you to do. To be honest, I don't even listen to people that encourage me to do things, right? It's the same thing. Like there are people who don't want you to do stuff because they think it's risky. There are people who want you to do stuff because they think it's a great opportunity. I don't care. I will do my research. I will look at the data. I will talk to the people that are relevant to that particular conversation. If I want to understand Queensland property market, you're my first call, right? Matt from HTAG and Alex from HTAG, you know, understanding the data, and then you're my first call because you understand this better than anyone I know, right? Similar to you. If you wanted to know a little bit more about Melbourne, or you want me to pop over to a suburb, I'm the person, right? But I'm not listening to Uncle Bob at the barbecue. Because Uncle Bob doesn't know shit.
But everyone claims to be an expert. That's the problem.
Armchair experts. I mean, we're sitting in armchairs.
We're sitting here. but just to clarify, we are the experts.
That's right. Yeah, but it's a different armchair. I'm talking about the other one. Yeah. Not this one.
100%.
So we're in Darwin. Are we talking Darwin City? Are we talking? Is there a suburb?
So we've been buying in Durack.
Hey.
Nice. Durack. We like Durack, Grey, Zocoli, and we've got one that we're putting under contract today, and I'm dying to check my phone to see see what's going on. Because my team's managing it. I'm not, but it's 480K. It's 800 plus square meter block, and it's a house, and it rents for 580.
Oof, that's good.
Right, what's that? Is that 6.2? 6.2% yield.
Can you walk us through what kind of an investor did this appeal to?
It's appeal to someone who's, funnily enough, from Melbourne, already got a Melbourne property, and is looking in Queensland. And I actually have the stock that they're after in Queensland, but I've kind of said, hey, I really believe this is better for you. Mind you, I've got like 3 or 4 clients I could sell this property to. It's a great property, but this client obviously signed up first, so I'm offering it to them, and they're coming back. They're just talking to their accountant. So 480 purchase price. The property in 2012 was $495,000.
Nice. Okay.
So one of the things that I love looking at is seeing what things were worth 10, 15 years ago. And when we're buying today, cheaper than it was back then, with all the metrics aligning and that strong rental yield with the low vacancy rate, when you really look at that, that gives you a fantastic indication. Obviously, you have a look at your other metrics, make sure you check all your data, and then talk to the locals and so on. But that is just a no-brainer. You cannot get major city capital city yields like that. It doesn't exist.
No.
You can't find them regional.
Yep.
Like regional's 5% now.
Yep.
So 6.2. And if you buy well, you get some good rent, whatever, you can find a 6.5, 6.7.
That's amazing.
Percent yield. That's amazing.
So 480 purchase price. Knowing what I know about you, you would have haggled the shit out of the agent. What do you reckon is the sort of current value for the property right now?
Oh, it's already it's valued at 525. So we're 45K under market
So
value. This is the best part about, and this goes back to what we were talking about. Buy before everyone is onto it. My client's got instant 45K equity. They'll be back super quick because you know what's going to happen. That property is going to go up in value over the next 12 months. They're going to be back with $120,000 to go again and buy something else. And that's how you grow a property portfolio.
That's how you grow it. That's
right?
good,
with
man.
minimal negative.
That's amazing.
Without a 3.5% yield or 4% yield. You know, you
I
got
think that's the main thing, right? If you're buying at 6.2% yield at purchase, right, you've got, you know, whatever, your 6.5% interest rate, interest only. You've got your holding costs as well, but then maybe you leave some of your savings in your offset accounts. It's not costing you too much money. Next time when you go back, your serviceability is actually not that bad because the bank's looking at, and you probably had a rent increase by then as well. So your 6.2 is probably sitting at 6.5%. So your serviceability is good. You've got a bunch of equity that you can pull out. Yeah. That's how you win the game, right? That's the finance game. Because
don't forget, you're 100% right. You're adding to your loan when you extract your equity. Now, back in the day, we were looking at, everything ranging from, 6% to 9.4% yield out of the properties that I was purchasing when I was scaling my portfolio super quick, right? And it all averaged out at 7.5% average, right? That's units, townhouses, and houses. And houses were, 280 grand renting for 350, right? So this reminds me a little bit of the old days.
That's it.
And I can see it, and it's so obvious. And you know what? Darwin's going to go so fast. And like I said, if I was starting out again from scratch with 0 properties and I had a deposit, it would be Darwin.
Beautiful.
Right now.
I like the conviction, man.
So whoever wants to argue.
So just to be clear though.
Let's watch it. Let's play it out in 12 months. Let's remember this for 12 months.
So just to be clear though, when you said top 5 Queensland suburbs, what you meant was top 3 plus this other one. Plus this other one and then this other one.
And then this one.
That's what I like about you.
Hey, it's my fucking podcast. I said the F. Can we cut that? So I'll do what I want here. All right, I'm the boss here. Besides Sophie's still the boss. But yeah, so I wanted to give an example because I know Brisbane. I want to give someone something for Brisbane, and honestly, the best bit of value I can give is what I'm doing for myself.
I think
that's the number one
fantastic
takeaway.
Way to put it. Beautiful.
Yeah,
I like that.
Mr. Adi, any arguments?
So many, but nothing to do with what you've just said. It. So many.
Anyone that's got a disagreement, I'd love it in the comments, and because I need the engagement. And yeah, let's watch this 12 months from now. Let's January 2026.
That's it.
Let's just put a pin in this for a year.
How about we catch up in 12 months' time?
Let's do it.
29th of Jan.
Yeah. See how it played out.
And we can all discuss how you were wrong. How's that?
Whoa.
All right. I'm kidding.
Let's put some cash on it.
I don't want to do this anymore.
I love it. Mr. Adi, congratulations on the new venture.
Thank you, sir. I appreciate you.
Thank you so much for coming.
Thank you
I
for having me.
appreciate it.
Thank you, man. This was fun.
Yeah, it was.
Good banter. I like it.
Well, it's probably banter. I try and I think I'm a little bit too serious sometimes with trying to be professional. I just want to be me, and it was good. We got to and I said the F word too. So that is a little bit of my personality.
That's it. Yeah.
Thank you so much for joining us. Please like, subscribe, share with a friend, and we'll see you next time on Property Banter.